Hello good people, it's me Kumetsila Khositsile, your money manager. Today I want us to talk about this very important topic. I want us to look at how to be tax efficient as a property investor. You know, as you start your property investment journey, the one thing that you have to consider is taxes. So this week I had an opportunity to meet with one of my coaching clients, and really the objective of our coaching session was to explore ideas of how to be tax efficient, and I don't know of any other way. So we looked at the fact that, you know, he is already on the high income tax bracket. So what was going to happen is that with more rental income that he's getting under his individual capacity, that is going to add to the already high income, and that is going to make his taxable income even high, and he's going to end up paying high in taxes. I know we all cringe when we look at our salaries and we look at the amount of money that we're paying to government in taxes, and we are always looking at the best legal ways of trying to reduce that money that we are paying to a government in the form of taxes. So if you are a property investor, and if you have just started out, maybe you are not feeling the pinch because the rental income that you are getting is not substantial. So for you, it's like, okay, it's okay, what's the fuss all about? But if you are a property investor and you are looking at growing your portfolio over time, like big sizable portfolio, then being tax efficient is one thing, has to be top on your mind. It's something that you have to be thinking about and working on, and you need to be engaging tax experts to help you with planning your properties and arranging your investment in such a manner that they will help you to be tax efficient. Remember, I am just sharing this with you from a practical point of view, from experience point of view. I am not a tax expert. So if you're looking for tax advice, please make sure that you consult with a tax expert. So in my case, what I have done is that, obviously through the many books that I've read on real estate and through interaction with other real estate investors, what I'm doing is I don't own any of my properties personally. So the advice that I got earlier on was make sure that you incorporate a company and own your properties under a company. And the reason for so was that when you look at end income, which comes in the form of salaries, and you compare it to other different investment income or even income from the company, the tax treatments are different. So for an individual, for end income, this is what happens. You earn your salary at the end of the month, your basic salary. And before you can even have that salary in your bank account, what is the first payment that you make? If you are not a member of a pension fund, the first payment that you make is taxes. So you are taxed on your basic salary before you can even receive the money. And you only get the balance, the net, after the tax. So the treatment is that end income salary, you pay tax first, and then you spend what is remaining, the net. But when we look at the company, the treatment is totally different. So as a company, you are going to have your income, and in our case here is going to be your rental income that is going to come from you. After receiving your rental income as a company, you are going to take out all the operating expenses, all the expenses that you pay for this property to continue generating your income. This is our operating expense. You are going to less them from your income, and you're going to remain with your net. So you are going to pay tax on the net income. Do you get that? You are going to pay tax on the net income, the deducting all your expenses. So you can see the treatments are totally different. Somebody who's receiving maybe a salary of 40,000, and then you add rental income. So if the rental income is under your individual capacity, this rental income is going to increase your income. So it's going to be the salary of 40,000. Say you are receiving rental income of 10,000, you are adding that 10,000 to the 40,000, that is going to be 50,000, and you are going to pay tax on the 50,000. Do we get that? You pay the tax on the 50,000 and then you spend the balance. Now, as a company, if you're earning a rental income of 50,000 that is coming to your company, you are going to deduct all the expenses, Could be insurance, maybe your salary, maintenance expenses, garbage collection, utilities, depreciation, interest if maybe you finance the property using debt. So you deduct all these expenses and then you are going to be taxed on the net at a company tax rate. This is one way for you to be tax efficient as a property owner. Make sure all your properties are owned by a company, your company, not individually owned, because if they're individually owned, they are going to increase your taxable income and you are going to pay more taxes. This is the starting point, and this is what I can share with you. So with the meeting that I had with my coaching client, we were able to explore this. However, we had to also consider the limitations that will come with owning your properties as a company, more especially if you're starting out, because one limitation is when it comes to financing. If you're looking into using the conventional financing, the traditional route of financing where you're going to the banks, you need to be aware that most banks, commercial banks, they shy away from financing startups. So that is the one thing that you need to be aware of. Yet, as an individual, your rental income is going to increase your salary, and you are more likely to qualify for a higher amount and even build more properties. But remember, the higher amount that you're generating, the more taxes you are going to pay. But you stand the advantage of easy access to credit using your salary, because your salary is the most consistent income that you can ever get, and the assessment is quite easy on your individual capacity as compared to the assessment on a business side. So this is really the limitation that you need to be aware of. But as and when your portfolio is growing and you are building the track record, it becomes more and more easier for you to access financing. It's a trade-off. Do you want to pay more in taxes, or are you looking at the ease of accessing financing? So that's really up to you and what you want to achieve at the end of the day. So this is really all that I wanted to share with you today, to remind you that you need to consider be tax efficient as you embark on your journey of being a property owner. This is all that I had for you today. Hope you found this video insightful, and please don't forget to leave a like and a comment for me. Thank you very much for watching. I will see you in another video.